Good morning.
Good morning, sir.
I hope you all can hear me. Is it?
Yes, okay.
Hello. Can you hear me, please?
Yes, sir.
Yes, sir.
Good.
Yeah.
Okay, thanks. Good morning again.
Good morning, sir.
Good morning, sir.
So, any questions before we start? Now you can see the presentation.
Yeah.
Okay, good. Any questions? Okay, if you don't have any questions, let me brief what we discussed last week. We discussed about futures pricing. How do we derive or decide the price of a futures contract? The model we used is called, what's the name? Cost of carry model. The name of the model we use is cost of carry model. So what does it mean? We derive the futures price of a futures contract based on the cash price of the underlying asset, that means the spot price, and any costs that the holder of that asset may have to incur, and any benefits received by the holder of the asset. So we start with the spot price, then we calculate the cost, we add that cost to the spot price and subtract the benefits that we receive. That's the basic concept. That's what we discussed mostly last week. Then we discuss the relationship between cash price or the spot price and the futures price. There can be instances where the futures price is higher than the spot price. Meantime, there can be other instances where the futures price is less than cash price. What do we call this difference? Cash price minus futures price. What do we call it?
Basis.
Basis. Exactly. So the difference between cash prices and the futures price, we call it as the basis. So the basis can be positive or negative. If the basis is positive, we call it in a which market? Depending on the basis, whether it's positive or negative, we talk about two futures markets. We give them two different names. If the basis is positive,
Backwardation. Right?
that's the backwardation market. That means cash price is higher than the futures price. We call it a backwardation market. When the cash price is lower than the futures price,
It's a content.
then what do we call it?
Content. Right?
Contango market. So that's what we discussed last week. And with the time, what would happen to the basis? Oh, simply, what happens to the difference? Whether it's positive or negative, whatever the difference, what would happen
It
when the time goes on, and when
price,
we get closer to the maturity of the or the expiry of the futures contract, what would happen?
it converges, right? It comes close, so it will be
Yeah,
almost same until the
futures price will get closer to
cash
the
price.
cash price or the spot price. We call it the convergence. So those are the things what we discussed last week. So I hope you can remember all those things. How to calculate futures price and what does it mean by a contango market. Futures price is higher than the spot price. Foundation. We talk about convergence. This is the base definition of basis. And again, I asked, oh, explain you what would happen with the time goes on. So in this is the cash price. This is the futures price. So whether the basis is positive or negative, in this basis is positive or negative, futures price is higher than the cash price, then the basis is
Negative.
negative. So then are we in a contango market or a backwardation market?
Contango.
Contango market. Okay. Whether the basis increased with the time or decreased with the time.
Increase.
Increase. Why? The negative figure at this in February, it may be the basis is about 5 minus 5. But when it comes to June, it may be about minus 2. So from minus 5 to minus 2, the basis has increased. So in this instance, especially, we have to think about the only just absolute figure 5 and 2. We have to consider the sign minus 5 minus 2. From minus 5 to minus 2, it's an increase. So basis has increased. What would happen in a backwardation market? So assume this the line below is the futures price, the line above is the cash price, then this becomes a backwardation market. What would happen to the basis? Then this basis would be a positive one, plus 5. In somewhere June, it would be plus 2. Then what has happened to the basis? Plus 5 to plus 2. Basis has decreased. So remember now, basis increased with the time generally in a contango market, while basis decreased in a backwardation market. Remember that. Is it clear? I asked you to think about it last week. what would happen to the basis when you are in a contango market and when you are in a backwardation market. So it's given here basis is negative in contango market and basis is positive in backwardation market. Basis must narrow to zero as the contract moves towards the expiry. That's what we discussed. That is what we call convergence. So if the market is perfect, what does this basis reflect? That is the cost of carry. The basis reflects what is the cost of carry because it's the difference between cash price and the forward price. Okay, if the basis is positive, do you have a net cost or net benefit? When the basis is positive, what do you have? Net benefit or net cost? When do we have the positive basis? We have the positive basis in a backwardation market. What does it mean by positive basis?
You have net benefits, right?
Yes, because basis equals spot minus futures. So if this is positive, what does it mean? Spot price is higher than the futures price. For futures prices to be lower than the spot price, you should have or you should get net benefit. Clear? So therefore, in a backwardation market, you have net benefits, and in a contango market, you have net cost. So the basis reflect that in a perfect market. But the thing is, markets are not perfect. That means there are no there are different various barriers in the market. There may be taxes, transaction costs like brokerage fees, things like that, and the information may not available. Therefore, in practice, it may not be exactly the same thing. What would happen? And the prices will depend on the short-term supply and demand pressures as well. If you think price of some underlying is going to go up, people will tend to buy futures. Just because of the demand for futures is going up, futures price may go up. So that can happen. That will distort, or the basis may not perfectly reflect only the cost of carry. So therefore, the basis can theoretically, based on the model, basis can change because of whether if the interest rate changes, your cost changes, or the benefit changes, your benefit changes, benefit rates or something changes, your benefits will change. So accordingly, basis would change, and with the time to maturity, remaining time to maturity, basis would change. That's based on the theoretical or the model that what we discussed. But in practically, the basis can change. Apart from these two, which is already in the model, the changes in supply and demand also causes for a change in the basis. So these are obvious: cost of carrying, interest rates, insurance costs, dividend yields, all these matters. If interest rate changes, futures price changes, because your opportunity cost is change whenever interest rate change. If the insurance cost increase or decreased, your cost will increase or decrease accordingly. Dividend yield or whatever the benefit changes, futures price changes, so therefore basis change. Time to maturity, mostly at least this interest rates in interest cost we calculate based on the interest rate and time to expiry. If the time to expiry goes down, because when we get closer to maturity, time to remaining time to expiry goes down, so your costs and benefits may be low. Therefore, we observe this convergence. So all these three factors, main factors, results changes in basis. Two of them are obviously or very clearly included in the model. Only thing is supply and demand, you cannot see it through the model, but it is inherent in the market. What is basis risk? There's a risk because of this difference between cash price and the futures price. The thing is, the risk is if the spot price increase by $1, change in futures price, we don't know. It is not 1 to 1. Change in $1 in the spot price, it won't result a change in $1 in the futures price. It may be more than $1, it may be less than $1. And with the time, depending on the interest rates, and that change also, that difference also changes. So that's what it's explained here or mentioned here. The risk that a futures price will move differently from that of its underlying asset, but generally towards the same direction. If spot price increases, futures price also increases, but by different amounts. That is the risk of the basis. That is we call basis risk. So the futures price and the cash price or the spot price change by different amounts. Therefore, the basis would change time to time. Even if the basis remains constant, that's fine. We know that would be the difference. It won't happen. The basis, the difference between cash price and the spot price changes time to time. That's the basis risk. But thing is, this uncertainty is less than the risk of the underlying asset. Price changes of the underlying asset. If you say you have a $1, what is the risk? The dollar rupee exchange rate changes will give you a profit or loss depending on the exchange rate. But if you have a futures, what would happen? The basis is the difference between spot rate and the futures rate. When the exchange rate changes, spot rate also changes, futures rate also changes, and the basis also changes, but the change in basis is much smaller than the change in the spot price. Remember, I'm referring to the change in the basis, not the change in the futures price or change in the spot price. Change in basis is small than the change in the underlying asset price. So therefore, basis risk is significantly less than the market risk that you take on the underlying asset. Only way for you to eliminate this basis risk is you have to hold the futures contract until the expiration. Why? On the expiry date, futures price equals to what? On the expiry date, futures price equals to
Spot price, sir.
spot price. So there's no basis, so no basis risk. You realize whatever the futures price you entered into and the spot price as the profit or loss. So because of this convergence, if you hold this futures contract until expiry, there won't be any basis risk. We'll explain with an example towards the end. How do you calculate this and how do you face this basis risk when you use futures transactions to hedge your position? Then we move into arbitrage trades. What is an arbitrage trade? We discuss arbitrage trades in foreign exchange markets. What does it mean? Arbitrage trade. What do you do?
Get benefited from different prices in the market for the same asset?
Yes. If the same asset is priced in different markets at different prices, there's an arbitrage. You can buy from the cheaper market and same time you can sell it in the expensive market and you book the profit. So without taking any risk, you make a profit. That's the arbitrage. But here, remember, what do you mean by different markets? It's not like two physical markets. It's a one way. You may remember we discussed that one as well when we discussed foreign exchange markets. When you have two different markets, physical markets, still you can explore arbitrage opportunities. But here we are not referring to physical markets like Japanese market and Singapore market, something like that. It's not the case. Here what we are referring to, different ways of pricing or implicit prices in through different instruments. Here we are going to discuss the pricing through futures and the cash price of the underlying asset. Through these two different markets, we may observe different prices. Whenever we see that, we can explore that opportunity and make a profit. So basis trading can be considered as an arbitrage trade. What does it mean by basis trading? So what do you do? The basis is the difference between cash price and the futures price. You trade that difference. You buy that difference. So if now the difference is 5, you buy it. When it goes to 6, you sell it, something like that. However, I'm not going to discuss basis trading, but ultimately what would happen in arbitrage trading, you trade this basis, the difference. So, however, as I explained, through futures, how do we explore the arbitrage opportunities? And when we can have arbitrage opportunities is that whenever the futures price is not priced fairly. If the futures price is not fair, then there will be an arbitrage opportunity. Then we can do few trades and make a profit. The same concept applies here as we discuss in foreign exchange market. You might remember in the foreign exchange market, we explore these arbitrage opportunities with the forward contracts. What is the market forward price and what is the implied forward price? If there's any difference, we know what to do. The same concept is applied here. So I think you can remember what we did in the foreign exchange market. So simply the concept here is whatever the expensive market, you sell that in that market, and wherever it's cheap, you buy in that market. Sell high, buy low. The same concept is applicable here. So we'll consider that there can be two opportunities, two ways of arbitrage. One is when the market price of the futures, if you go to the market and check a price of a futures contract, you observe the market price. If it is higher than the cash price plus the cost of carry, that means this is the model price using our model. Because in that model, what we do, how do we derive the fair price of the futures contract? Cash price plus net cost of carry. Cash price plus cost minus benefits. So if the market price is higher than the price, which can be derived using the cost of carry model, or we can call it the fair value of the futures, then there is an arbitrage. Market price is higher than the implicit price. What do you do? Use the concept sell high, buy low. What do you do when the market price of the futures is high?
Sell it, sir.
Sell what?
Sell the basis.
Sell the basis. Okay, without confusing with the basis, tell me whether you sell the futures or sell the underlying. What do you do?
Sell the futures, sir.
Sell the futures. Because its price of that futures contract is high in the market. So it's expensive. Okay, the first step is to sell the futures. Then to cover that position, what do? Now you have to create a synthetically a buy transaction, futures buy transaction. Otherwise you get exposed to the market price. In arbitrage opportunity, in arbitrage trade, you don't take any market view. Whether market goes up or goes down, you make a profit. You should be able to make a profit in an arbitrage trade. So you are not taking any views on the market, but you try to explore the differences in market prices. So futures market price is higher than the implied rate, so you sell the futures. Now, what's the obligation now you have? Once you sell the futures,
You're supposed to deliver at the
you
maturity.
are supposed to deliver whatever the underlying on the expiry date. How do you cover that?
So you can use as proceeds to buy the underlying, right?
Yes. So uh, part of the answer is correct. Whenever you sell a futures contract, do you receive anything at time zero? That means the moment that you enter into a trade.
Right. Okay.
Do you receive anything? If you sell the futures contract,
No. You're entering into the agreement still, right?
you just enter into an agreement. No cash flow there. So you don't receive anything.
Okay.
But the second part of the answer is correct. What do? You buy the
Underlying.
underlying. To buy the underlying, what do you need? To buy the underlying, what do you need?
Are you going to have another contract there?
No. Yes, sort of another contract, but what you're going to do now, you want to buy the underlying asset in the cash market. To buy the underlying asset in the cash market, what do you need?
Cash, sir.
You need,
cash, right?
sorry?
You
Cash.
need cash, right?
Cash, yes. How do you get cash? From where do you get cash to fund your position? Did you discuss about transfer pricing theory? Yes, you discuss about treasury management. So I think Perry discussed with you.
I don't know if we discussed specifically about transfer pricing. He mentioned that. I don't know if that was explained.
Okay, as a bank, if you want to buy something, how do you find cash?
Do you loan from another department?
Sorry?
Do you take like? Do you borrow from another department? Okay.
You borrow. As the bank, you borrow. It may be from another bank or from customers. So you borrow. You need to borrow money. So that's why I asked whether you have discussed transfer pricing mechanism. So as a bank, you may not specifically borrow funds to fund this transaction, but you have funds borrowed from customers as you take it as deposits. So you use those funds to buy this underlying. But for those funds, there's a cost depending on the market trades. So that's what in the transfer pricing, what you do whenever any unit need funds, Treasury will transfer that price at the transfer pricing according to the transfer pricing policy of the bank. So however, simply you have to borrow funds. Those are the three transactions that we have to carry out. This is the first transaction. This is the second transaction. And this is the third transaction. We have to carry out these three transactions immediately to explore this arbitrage opportunity. So the market price is higher than the, market futures price is higher than the implied futures price. So therefore the market is expensive. You sell the futures in the market. Meantime, you go to the cash market and buy the underlying asset. Same quantity, whatever the quantity you sold here, you buy the same quantity here. To buy that, you need cash. You borrow the same amount for what period? What should be the tenor of this borrowing?
The duration of the futures contract.
Yes, exactly. It should be equal to the time to expiry of the futures contract. So if it is a 3-month futures, you borrow for 3 months. If it is a 1-year futures, you borrow for a 1-year period. Okay, what would happen on the maturity date or the expiry date of the futures contract?
You deliver the underlying and get the proceeds and settle the loan.
Low, exactly. So now you have the underlying asset because you have already bought. You keep it until the expiry of the futures contract. On the expiry of the futures contract, you deliver your asset. You get whatever the futures price that you agreed, and there's a borrowing that you have to settle. So how do you get your profit?
Difference between the cost of the borrowing and the gain from the market price difference of the futures.
Yes. The thing is cost of carry plus cash price. This is the intrinsic value of, or the fair value of the futures. This is the market price. So you borrow some amount. That's the cash price that you need to buy the underlying asset, and you have to pay some interest after 3 months. That principal amount and the interest is less than the price that you agreed here. So therefore, once you settle this future settle as a sell transaction, you get more than this. You settle this part as well, the borrowing, there will be definitely there's a difference. You get it as the profit. So we'll move into a example, then you will be more clear on that. So any question, is the concept clear here? So basically these two together construct the synthetic futures contract. You sell the futures contract here. This is the synthetic buy of the futures. Buy the underlying and borrow money, buy the underlying and keep it for a 1. That means you bought So we'll move into the example. A barrel of crude oil is currently traded as US dollars 103.75 in the spot market. A 1-year futures contract on crude oil is selling at US dollars 109.34 per barrel. You can borrow dollars at 2.5 per annum. First thing, again, how do you identify whether there is any arbitrage opportunity? Futures price is given now. This is the futures price. This is the spot price. How do you identify whether there is any arbitrage opportunity? Can you remember what we did in foreign exchange? When the spot rate and the two interest rates are given, and the forward market rate also given, what is the first step that you do to identify whether there is any arbitrage opportunity? This is the futures price, market price. How do you decide whether there is an arbitrage opportunity?
Calculate this future value of this.
You have to calculate what? Futures fair value. How do you calculate future fair value?
How do you know the cost of carry or this one?
That depends. So depending on the underlying asset, you know what are the cost or the benefits that you know in practical situation. But in a like say assume in your exam, so whatever the given information, based on that you have to decide. So what are the information given here? Just the interest rate. So then you can decide, okay, in this only the cost of funds is the cost. There's no I'm not sure. Yes, I have not given any storage cost or anything, insurance cost or anything here. Just to make it simple, calculate the future fair value and compare it with the market value. So based on the given information, you can calculate what is the fair price, what would be the cost, what would be the benefits, but if there's any. So then calculate the futures price as we discussed last week. The first step is to calculate the fair value of the futures price. So as I mentioned here, so there's no any other costs given. First step is to calculate the fair value of the 1-year futures contract. Why 1 year? The price is given for a 1-year futures contract. So can you calculate it and let me know what is the price? What's the futures fair price. What's the answer? It should be. Any answers? Oh, would it be more than 103.75 or less than that?
Should be more.
More than.
It should be more than 103.75. Why?
Interest cost.
There's only a cost. There's no benefit. So it should be more than 103.75. Okay, what's the value?
106.34375.
106.34375.
34375.
Four, 3, 7, 5. How do you get that? It's very simple. Simply, what do we have to calculate? What is the future value of this 103.75 in 1 year at 2.5 multiplied by 1 plus 2.5 divided by 100. You should get 106,34375. That means 103.75 multiplied by 1.025. It's not a big deal. So this should be the answer. So I have round off to make it simple. 106, 3, 4. This is the cash price. This is the cost of carry. All together, price is the future value because there's no benefits, just the interest cost. Okay, now you calculate the fair value. Now tell me, once you compare these two, is there any arbitrage? Is there any arbitrage opportunity?
The future contract
Yes.
price is high.
Yes. Future market price of the futures contract is higher than the theoretical or the intrinsic or the implied price in the through the market. So therefore, what's the arbitrage profit that you can earn if you do any trade?
2.9.
Sorry,
2.996, right?
something like that. So almost $3 if you take it as 109.34 and 106.34, or $3 arbitrage profit. So you can incur a arbitrage profit of $3. That's the difference between market price of the futures contract and the fair value of the futures contract. But to get this, what do you have to do? You have to do some trades to make this profit. You have to do some trades. What are those trades? The 3 transactions that I explained earlier. Since the futures price in the market is higher than the fair price, market price is higher than the fair price, what do? You sell the futures contract, now, and borrow some funds, the required funds to buy the asset, and buy the asset. Whenever you buy the tenors has to be same for the borrowing and for the futures contract. Tenors has to be the same. So whatever, now in this example, 1 year futures contract. So therefore you have to sell a 1 year futures contract, borrow funds for a 1 year period, and buy oil. That's what you have to do. You have to buy oil in the cash market. What would happen on the expiry date? So since what is your borrowing cost? This is that 2.5% given there. So on the maturity date, what you have to pay for your borrowing is just 106.34 on the maturity date. That means after 1 year, for your borrowing of $103.75, this is the amount that you are going to borrow, because this is the price of a oil barrel. You need this 103.75 today to buy one oil barrel. After 1 year, at 2.5%, you have to pay 106.34. But since the futures price of the one futures is 109.34, on the expiry date, you receive 109.34. You pay only 106.34. The difference is your profit. You make a profit of $3. That's what happened. Is it clear? Any question? And this one, we call it as cash and carry arbitrage. What do you mean cash and carry arbitrage? You buy in the cash market and carry the position until the futures transaction is expired. That's why it's called cash and carry. You buy from the cash market and carry the position. Any question? Is it clear? Okay, then what you would do if it is other way around? I'll come to this later. If the futures is trading below its fair value, if the futures is trading below its fair value, that means the market price of the futures contract is less than the cash price plus the cost of carry. Now what do you do? What are the transactions that you will do to explore the arbitrage opportunity or to get the arbitrage profit? What do you do? What do you do with the market futures? Now which one is cheap?
Cash spot price.
Sorry?
Prices.
Spot price. Today's price.
Today's price of what? The underlying asset or the futures?
Future.
Yes. Today's the market futures price is cheap. So you buy this. You buy a futures contract. Now, what's the obligation that you would get when you buy a futures contract? What is the obligation that you have?
So you have to buy the asset at the.
You will receive the asset on the expiry of the
Yeah.
transaction. So to hedge that position, obligation to deliver the asset in the how do you do that?
So do you sell it short?
You sell the asset underlying asset. Then once you sell this asset, what do you get? Once you sell the asset, what do you get? You sell it in the cash market.
Cash. You get cash, right?
You get cash. What do you do with those cash?
You loan the.
You lend that cash for a period of
Futures contract.
same period of the futures contract. Basically, these are the three transactions that you have to carry out, but in this there's another fourth transaction as well. So you sell the asset here. Once you sell it in the cash market, you cannot wait until the futures market to deliver it, to give that asset to the buyer. If you sell the asset in the cash market, you may have to deliver it in 1 day or a 2 days time, depending on the regular settlement date. If you don't own this asset, how do you do that? You may have to borrow the asset from someone else and deliver that asset to the purchaser. You borrow the asset and deliver that asset to the buyer of the asset in the cash market. You may have to pay some commission for that borrowing. On the maturity date or on the expiry date of the futures contract, you can collect the asset, deliver it to the lender of the asset, because you have already settled this transaction. This one settled in the cash market. But here there's a borrowing of the asset. On a future date, what do you do? From this, you deliver it to the lender of the asset. There will be a fee for that. You pay that fee. And since not only that, when you buy this asset, you have to pay cash. For that, you use this proceeds of your lending transaction to buy this. Once you settle all these things, there should be a positive cash flow for you. But in this, we don't consider cost of this borrowing. But in reality, you have to consider that one as well when you decide whether there is any arbitrage opportunity. So since this is exactly the opposite of the previous transactions that we carried out, here what we did earlier, sell. In the cash market, we bought the asset instead of selling. And we borrowed funds instead of lending. But here we do the opposite or the reverse of these previous transactions. That's why we call it reverse cash and carry arbitrage. You do the opposite of the cash and carry arbitrage. So therefore we call it as reverse cash and carry arbitrage. So where you buy the futures contract, sell the asset short, and lend the short selling proceeds. Those are the three transactions that we carry out. But generally, when we sell it short, to meet that obligation, we'll have to borrow the asset and pay a fee for that borrowing. So this is an example.
So excuse me.
Yes.
So excuse me. I didn't understand the fourth step. Fourth one.
Fourth step is, say, if you sell something which you don't have, you sell something which you don't have, but say in 2 days you have delivered that to the buyer. How do you do that? You borrow that asset from a party who is having a position and who is willing to lend that asset to you. You borrow from that party and deliver it to the buyer of the underlying asset. But the party who lends you that asset, that party will charge you a fee, lending fee. When you return the asset, you have to return the asset plus the fee that you agree to pay. Is it clear?
Yeah, okay, sir. Then now clear.
So in the financial markets, whenever you say you are selling something, it doesn't necessarily mean that you had it in your possession. If you had it, fine. You had a position, you sold it. Even without having anything with you, you can enter into a sell transaction. We call it a short sell. You don't have that asset in your possession, but you entered into a sell transaction. That means you create a liability, short position, short selling. So, but to meet that obligation, either you have to buy back the same asset before the settlement date and deliver it, or you have to borrow the asset and deliver to the buyer. So in this futures arbitrage, you don't buy it from the market again, then you will get exposed to the market price again. So instead, what you do, you enter into a short sell transaction and borrow the asset and deliver it to the buyer of the underlying asset. On the expiry of the futures contract, you settle that borrowing. Remember, that's borrowing in the form of an asset, underlying asset, not necessarily cash. So in this example, these two are remain same as the previous one. Spot price is 103.75. Borrowing cost is 2.5. Then we know what is the futures price. It should be 106.34 as we calculate earlier. Now what we have to do, compare these two prices. Futures fair price and the futures market price. Now you can see obviously fair price is higher than the market price. So the futures in the market is cheap. You should buy from the market. The difference is again 2.5. This is the futures price, fair price 106.34. Market price is 104.84. So the arbitrage profit, what you get is 2.5. Clear? So in this case, since you have to borrow, the asset, the lending fee or the borrowing fee of that asset should be less than 2.5. Otherwise, you won't get any profit. There's a small correction. Note it down this as reverse and cash and carry arbitrage, because we are discussing that one. So 2.5 is the arbitrage profit that we can get. To get that profit, we have to do these 3 transactions. Sell the asset now on the cash market, buy the futures contract now, and invest the sale proceed of the asset at 2.5 for the same maturity of the futures contract. But practically what would happen, since we are selling short here, whatever the sale proceeds, we keep it with the lender of the asset. It may be our broker or margin provider. That party will keep that money as a collateral, because we have done a short sale, and he will facilitate us to borrow the asset and deliver in the cash market. That's what practically happens. But that party will pay us the interest on the cash. Any questions?
So are these hedging opportunities still like they are in practical in markets, because with the algorithms and high frequency and all those, so is it possible?
You mean hedging or
the arbitrage
arbitrage?
Yeah.
Yes, they still there. For whatever reason that can happen, because now, especially in the markets, there may be regulatory requirements. Due to some regulatory requirements, you cannot explore this or not you cannot explore this arbitrage opportunity. The market won't adjust to correct this arbitrage.
No.
Spot price or the interest rates or futures price, it won't get adjusted.
Okay.
Sometimes it's very small, and you have to be, again, since as you mentioned all those things, this computerized environment, even to explore the arbitrage opportunity, you need the same sort of facility.
Yeah.
You may not be able to do it manually and to execute these.
Place the trade and
Yes,
do the
yes. Any other question? And the other thing is, not each and every market is liquid and fast moving as we expect or we think. So in those markets, still there can be arbitrage opportunity, especially in emerging markets. So this is another example of, if you don't have any questions, I went back to the slide that I skipped under cash and carry arbitrage. This is another example. You can see the current cash price is, this is a say stock index. Current cash price is 1,450. Fair value of future is 1,485. Current futures price is 1,497. Now you can see this is expensive. It is higher than the fair price. So futures contract is overvalued. What you can do, buy the underlying at 1,450 to buy that until expiry of the futures contract. In cost of 35, the difference is 35. That's the cost. And meantime, sell the futures contract. So the difference between the fair value of the futures contract and the market futures price is the arbitrage profit. So in this case, it is 12. This is an example of cash and carry arbitrage, where the futures price in the market is higher than the fair price of the futures contract. So at the end, there's a almost same example for a reverse cash and carry arbitrage, where fair value is higher than the market price. So then what do? Sell the asset, you get this proceed, invest it, then you will earn a $35 and you buy the futures contract, you deliver it on the expiry, you will get the gain of this $8 on the expiry. Is it clear? Any questions? So if you don't have any questions, we'll move forward. What this slide explain is, since this is related to basis, it's not necessarily to wait until the expiry of the futures contract to close out your or make the profit of your arbitrage opportunity. Even before that, whenever you see the basis has changed in the way you want, you can close out before the expiry. But in that instance, then you have to reverse all these transactions. You might remember I explained last week also, even though we talk about arbitrage and even what we discussed previously, not all arbitrage opportunities that we can explore due to different reasons. So there can be a price range. Within that, you would see there's an arbitrage, but nobody can explore it due to other constraints. That price range, we call it as arbitrage channel. Basically, that happens due to transaction cost. So all these examples, we use just one price, even for the spot price, even for the futures price, even for interest rates, we use just one price. But in the market, you know, there's a bid and offer. Even for the futures contract, there's a bid and offer. If you buy the futures contract, at what price you buy, if you sell the futures contract, same, it would be at a different price. Bid and offer spread is there. Borrowing and lending, same thing, two different interest rates. Cash market transaction, spot rate or the cash price, bid and offer is there. So there will be a spread. Once you put all those things together, sometimes futures price and the arbitrage price or the fair value would be comes in two different comes as two different prices. But still nobody can explore that, because ultimately you won't get any profit once you pay for this transaction cost, once you pay for the spreads. How? So the line shows you the what would be the fair value. Then the fair value and the market futures price is not the same, but nobody can explore the arbitrage opportunity, because once you do all these transactions, either you get zero or you don't, it may be negative. Your arbitrage your profit may be negative because of the spreads and other transaction cost. In futures, you have to pay the transaction cost for your broker. So all those costs that you have to consider here before you try to explore the arbitrage channel. So therefore, simply the fair value, it may not, and fair value may not be same as the market value. There can be a small deviation between the fair value and the market value for the futures contract because of these reasons. So therefore, that creates a channel within which the upper bound and the lower bound, the futures price can deviate from its fair value. Nobody can explore the arbitrage opportunity. But if the price moves away from this channel, say somewhere here, market forces. So if this is the market futures price, is it overvalued or undervalued? It's above the fair value, so it's overvalued. People will start to sell the futures contract and buy the underlying asset. What would happen when you sell futures contract? Price of the futures contract will go down. Meantime, underlying asset price will go up. Then both will get a fair value of the futures contract will start to go up. Market value of the futures contract starts to go down, and ultimately this will come into the pair. In a perfect market, this would happen very fast. That's why someone asked a question whether these opportunities are available in the market. Yes, those available, but very rare, and you have to act very fast to explore the arbitrage opportunity. On the other hand, why do we learn this? It's not only to explore the arbitrage. Whenever you do pricing, you have to make sure that your price won't give someone else to get an arbitrage profit. If your price is not fair, then that will create arbitrage opportunity for someone else. So that's the concept here. That's why we need, or we have to learn about this arbitrage opportunities and the concept. If you remember, most of the pricing equations that we discussed, we use the concept of no arbitrage. Is it clear?
So,
Any questions?
about the arbitrage thing? So when you trade on, so these are traded on margin, right? So does that affect your
What trade on margin?
futures, right?
Futures trade on margin, yes.
So, like the daily mark to market and all, does that have an impact on your arbitrage? You said
Yeah,
that it is not exposed to market, right?
not exactly. There can be, because even for your margin account balances, you get interest income. If it is drastically different from the market rates, then there will be an impact. Otherwise, it won't. So, however, that's why all these transaction costs that you have to accounted for when you decide whether this arbitrage opportunity will give you a profit or not. You have to pay fees for our brokers. That depends on the number of contracts that you do. That's a different topic. However, you have to consider all those things. True. So that's what it's not an easy task to identify whether there's an arbitrage opportunity. Again, to be quick, you need high computational power and real-time data feed as well. Without real-time data, you cannot derive prices. So you need that one, that facility as well, and it is costly again. Anything else?
So Shanta, since everyone is fully, like normally any market participant is fully involved in trading and stuff, so that's why the arbitrage opportunities are very less, no? Generally.
Generally, yes.
Because everyone is aware what's happening.
In aware what happened, and they are in alert.
Yeah.
If the market is perfect, there shouldn't be any arbitrage opportunities. It should be corrected immediately. But the thing is, there are frictions in the market. Not everyone has the access. Say example, consider Sri Lankan domestic forex exchange market. If you see a forward price is away from the to explore that, you should be able to borrow 10 rupees the same rate that you apply to calculate the forward. Then there should be available foreign currency, either to buy or sell in the spot market. All those things matters. You should have rupees or dollars to do all those transactions. There should be other party. Whatever the price they quote whenever you go and ask for a price, it may not be the current spot price. There may be taxes practically. When you do a trade, if there's a taxes, you have to consider tax as well when you decide this arbitrage opportunity channel. All those matters. That the reason for this band is channel also is that there can be slight deviations where nobody can explore that opportunity. But generally, in a perfect market, price should come back sooner to the win the rally that can happen because of other constraints in the market. Not everybody has sophisticated systems to capture real-time market data and do the computation and monitor this. It's not the case. At least for a few minutes, that opportunity may be there. As I mentioned in the FX forward markets, in the global scenario, there's a very clear opportunity, arbitrage opportunity in dollar and yen market, because there's a high demand for dollar, and the capital requirement. If international banks keeps assets in dollars, their capital requirement is low, then keep it in yen due to these regulations. So they pay more for the dollars and lend cheap yen. So in the forward market, you can do a swap transaction, get dollars, or give dollars and get yen, deposit that yen in a different market, earn negative return. Still, in the overall trade, you get an extra benefit. So that sort of things are available in the market. Since everybody's having information on all this, and they'll be in alert, there won't be any arbitrage opportunities. It's not the case. Still, there are markets where you can explore arbitrage opportunities due to various reasons prevailing in the market. But not that common. Every time, in every market, you can explore arbitrage and make arbitrage profit. And what is the relationship between hedging and basis risk? What is an unhedged position? Underline asset. Your P&L will change based on the market price of that asset. That's an unhedged position. But through futures, you can hedge that position. What do you mean by hedging that position? Your P&L is fixed. It won't change. Your profit and loss will not change even though the market price. The position remains same while you are having a position when you do another transaction hedge this. So what do you do if you have a long position? You might remember we discussed in FX forwards as well. If you have a FX forward, sorry, if you have a FX long position, how do you hedge it? Through a forward contract. What do you do? FX long position, how do you hedge it? What is the forward contract that you entered into? Will you buy a forward contract or will you sell a forward contract? When you have a long position. Can someone remember? We discussed that. And there was a separate slide on that as well.
So when you say you're long, you have not made any transaction and expecting to do a transaction, or like we have already created a position?
What do you mean by you are long? What do you mean by you are long?
So you want to purchase, right?
You have a long FX position. What does it mean? If you want to purchase, are you long? What do you mean by a long position?
You have made a commitment to buy, right?
You have already bought. So yeah. Underline assets.
Sorry, sir, I lost you there. So
Forward mark. Sorry?
there's a bit of connection issue. So sorry, I just lost you there.
Hello, can you hear me?
Yeah.
Hello.
Now that's good. So yeah, it seems that from time to time we lose you at some, like, for a few seconds.
There's a connection issues, I think.
There's some interruptions from time now.
Now it's okay. Can you hear me?
Yeah, right now we can do. Yeah.
Okay. What? So my question is, what does it mean by a long position in FX market? Say that's true for any market. Say simply for FX market, what do you mean by a long position?
You bought.
You bought one currency. Definitely in other currency, it's a short position in FX market. So
Yes, sir.
you have bought one currency, foreign exchange or the foreign currency, say. Then if you want to hedge that position, what is the transaction that you, that's my question.
So you need to do a sell.
We have to do a forward sell transaction. We do the exactly the opposite transaction. If we have a
The exact same
same amount.
exact same condition. Okay.
Sorry?
with the exact same terms, right?
What do you mean exact same?
Like the
If
duration and the rate and all?
no, because you have the position,
Okay.
you know the amount, no exact rate.
Yeah, so you have to place another trade for the exact same rate, right? Is it possible? Oh, is it okay?
No. Forward rate won't be the same as the spot rate. If say now you have $1 million in position in your position, that means you are long. Is it clear? When you
Yeah.
say you are long, you have that asset.
Yes, yes.
The value of value of that $1 million in rupees, depending on the today's spot trade. If you want to hedge that position, what is the forward contract that you do?
So you want to go short on dollars, right? We lost you there again. It seems.
Because you have $1 million now. You won't keep
Sir,
the same, but the rate would be hello. Yes,
hello, sir. So there is a connection
yes,
issue,
I
I
can
think.
hear you.
Mr. Nishant, if
It's
you can,
interrupting with the.
Mr.
So are
Nishant, if you
there,
can try reconnecting.
so are there any updates? So scan is running.
No, I can't see anything like that. Can you hear me?
Now it's fine.
Now,
Yeah, now it's fine. Yeah.
Now it's okay,
now
sir.
it's
Now
fine.
it's okay.
Get it.
But time to
Fine.
time
That's
But
okay.
it's
Yeah.
gets interrupted. Okay, let's see. Okay, what I was explaining you, when you have a 1 million long position dollars and you want
Yeah.
to keep it for 3 months period and you don't want to take the exchange rate risk, what do? You enter into a FX forward transaction to sell dollars in
3 months.
3 months. So when you have a long position, you hedge it using a
Short
sell
position.
transaction, short position in forward market. If you have a short position, you enter into a long transaction in forward market. You do the opposite side. It is same here, even in the futures, because I mentioned at the very beginning, futures and forwards economically the same. The difference is how do we, or the mechanism and the other practices that we use. Otherwise, where do we trade futures and forwards? Those are the differences. Otherwise, economically, futures and forwards are almost same. Pricing is same. So even here, even you want to hedge your position using a futures contract, what do? You entered into a futures contract in the opposite direction. If you have a long position, you sell a futures. If you have a short position, you buy a future. Is it clear? Hello.
So
Can
can
you
you
hear
hear, sir,
me?
now? Can hear, sir.
You can hear. Okay. Is it clear what I explained? Even the futures contract, what do? You do the opposite of your position. If you have a long position, you sell a futures. If you have a short position, you buy a futures. But the thing is, as we discussed earlier, futures price and the cash price may not change by the same amount. That difference also may not, that means the difference may not remain as same during the life of the futures contract. That difference may change with the time. So therefore, your hedge may not be a perfect one. Even though you have hedged the position, there may be a small gain or a loss. If it was a perfect hedge, there cannot be any profit or loss. It should be zero. But due to this basis risk, that can happen. There can be a small profit or loss at the end. That is the basis risk, especially if you get a loss, that's a risk for you. So that's why we call it the basis risk. The other thing is future may not trade fairly. So again, that can create you a profit or loss on the hedge. So therefore, as I mentioned, your hedge may be underperform or overperform. What do you mean by overperform? You make a profit. What do you mean by underperform? You make a loss just because of this change in the basis. However, as I mentioned at the beginning, the change in basis is small compared to the market price. So therefore, whether you make a profit or loss, it would be very small compared to a possible profit or loss that you could have made if you kept your position unhedged. So therefore, this basis risk is very small, and most of the time we try to ignore it. But if you need, you can take some actions to negate that one as well, to make it a perfect hedge. So in that case, if you want to make it a perfect hedge, you may have to do more trades, or actively trade futures contract, adjusting your position to make it a perfect hedge. When you do that, there's a relevant transaction cost as well. So therefore, there's a trade-off between whether you go for perfect hedge or you go for a imperfect hedge. So what does it mean in March? Whatever the in March, FTSE 100 index is at 5,250, and September FTSE 1000 futures is trading at 5,275. So this is the cash price. This is the futures price. Okay, what do you mean by you want to hedge this? Say, if by September, if this index goes down to 5,000, will you make a profit or loss? You have bought this index and you hold it. You bought it today, paying 5,250. In 6 months' time, the index has gone down to 5,000. Whether you make a profit or loss,
You make a loss, right?
I hope you can hear me.
Yeah, we can hear you, sir. Yeah, so that would mean a loss, right? Index going down.
You have something, price goes down, it's a loss. whether it's a forward or a futures or foreign exchange or a stock, whatever underlying, it doesn't matter. Whatever your asset you have, if the price goes down, you make a loss. So this is a loss. So what would happen if this goes to 500?
That will be a gain.
It would be a gain. What do you mean by hedging? Irrespective of this price, whether it's 5,500 or 5,000 or 6,000 or 2,000, your value should remain at 5,250. You should not make a gain or a loss. Once you hedge your position, if it is a perfect hedge, value of your asset won't change.
So
Ultimately, you
you're
should have
hedging
the
275 or 250.
5,250 because this is your underlying.
Okay.
So value, or you should basically you should not get any profit or loss. That's the meaning of hedging. But how do you do that? Say your target time horizon is 6 months. So you are now in March. Target time horizon is 6 months. In September. So therefore, since you have a long position, what do? You sell a futures contract. You sell a futures contract. 5,250. Notion in March, and in March you sold a September futures contract at 5,275. Now let's assume now we are in August. Now the index is at 5,210 and the futures contract is at 5,237. So if we go back and compare the numbers, 5,250, 5,275, now both has come down. Index has come down by how much? 40 index points. Is it correct? Because 5,252 5,210. Index value has gone down in the futures contract. 37. What is the drop? $75 to $37. It's gone down by 38 points. Yes, 75 to 37. It has moved down by 38. Is it clear?
Hello.
Generally, market is going down.
I think so still it's
Hello.
Yeah, still we have issues. I think better for you to reconnect for your internet connection and try initiate the call. No?
Okay. We'll finish this and during the break, I'll
Okay.
reconnect. Yes. So, what is this minus 40? It is the drop in the index. minus 38 is the drop in the futures contract. Market has gone down, index value has gone down by 40 index points. Meantime, futures contract has gone down only by minus 38. Now, if we do the P&L for us, in March, this was our position. Index, we bought it at 250. Price in August, it's only now 502.10. So what is our loss on our cash position? Is 40. Is it clear, that part? Hello?
Yes.
Yeah, Mr. Rajan. That's okay.
That's clear.
Yeah.
So if we just hold that index position, we make a loss of 40. Without any hedging, we assume we hold that position. We make a loss of 40. But now, not only this, we have a futures position as well. What is the futures position? It's a short position. We have sold the futures contract. We sold it at 5275, but by August, now the futures contract is trading at a lower price, 5237. Are we making or are we losing?
Since we sold, we are gaining. No?
Since we have sold it, when the price goes down, we gain. But how much? What is our gain? Only 38 points, because this is the difference between the futures prices, 75 to 37. It's only by 38. What is our net gain or loss now? Once we combine the cash position and the futures position.
-2.
-2. So why do we get that -2? Because this is not a perfect hedge. If it was a perfect hedge, even this futures position should go down by 40 and give us a gain of 40. Because of that basis risk, it won't happen. Now, if you calculate the basis here in March, 5250 minus 5275, the basis is -25. But in August, what is the basis? 5210 to 5237, it's -27. Earlier, the basis was, in March, basis was -25. In August, basis was -27. You can see there's a decrease in basis by 2 points. That's the same as the loss we incur here. That's the basic risk. Because of the change in basis, our hedge may not be perfect. Depending on the change in the basis, we will make a gain or loss. So, however, if we didn't have this position, if this was not there, our loss is 40. But now, when we have this, our loss is only -2. We have minimized our loss to 2, whereas it could have been 40. So this is hedging and the basis risk of that hedging. Is it clear?
Here, the since we have hedged the March position 5250, that even in August we compare it against that, no?
Yes, this is our cost Oh, the 5250 is our cost. What is the value of our position in March at the beginning of the trade?
Yeah. So I understand that since we have hedged, our loss is 2, no?
Since we have hedged it, our loss is minimized to 2. Otherwise, it could have been 40. Say you buy something at paying 5,250. After 5 months, the price is 5,210. What is your loss? 40. But what you did, you bought this, and meantime you sold a futures contract. Now you have two positions, cash position and the futures position. Now your portfolio is a combination of a cash position and a futures position. Now what is your gain and loss?
In August.
In August.
Loss is 40, gain is 38. So net
is minus 2. You have minimized your loss. Remember, if it was other way around, same story, you minimize your gain as well. Even in a gain, say in August, instead of this is going to 5 to 10, assume it went to 300. And this one, say, what's your gain also?
We couldn't hear your changes on this, Srishant.
What is gain here? 250 to 300. Or in this example, what we discussed, if the price has gone down,
yeah,
ultimately we make a loss of 2. Instead of going down, what would happen if price goes up from 5,250 to 5,300? What is your gain?
50 will be the cash position gain.
Yeah, cash position gain is 50. Now, what would happen to the futures if it moves from 5,275 to 5,350? Are we making? Are we gaining or are we losing? Are we making or losing?
5,315 is the price in August.
August new price instead of this.
So that has also gone up by 40.
It has gone by 40. So is it a profit or a loss?
It's a loss, sir.
It's a loss because we have sold the futures. Price has gone up. So it's a loss of 40. 75 to 15.
40.
40.
Net position is a gain 10.
Now what is the net position is gain 10. So generally this won't happen. Because this is I just arbitrarily say it might be 318 or 22, 29. 1, something like that. Again, even we should not get, in general, we should not get a profit this much. But however, what I wanted to explain you, when the market price goes down, we limit our profit, so loss. Similar way, if the market goes up, we limit our gain as well. It should be very close to 0 if the hedge works properly. Is it clear? That's the meaning of a hedge. You don't expect a profit or a loss, especially when you use futures or forwards to hedge your position. Whenever you hedge, you forego on your upside and downside both. Is it clear? Any question? Hello.
Yes, I can. Yeah.
So is it clear? How do you hedge and how do you calculate your profit and loss? This and what does it mean by hedging? When you hedge, you should not gain anything or lose anything. Value of your portfolio should remain almost at the same level. Due to basis risk, it may not be exactly the same value. It may change by small amount. If it changed by a large amount, then your basis risk is high. Any question? Any questions? No. Okay, if you don't have any questions, we'll take a break here. And one thing I want to mention or inform you, from next week and onwards, we will try to do this more interactive, not only between you and me, even among yourself. Time to time, we may post some questions or discussion points. Not many, maybe 1 or 2 during the session, and we'll group you into small groups, maybe 5-6 groups. That would happen randomly. The groups will be created by the system itself. Then you can discuss among yourself within the group. You can quickly appoint a group leader and discuss and come up with the answer within maybe 10-15 minutes. You cannot you can discuss within the members of your group, not among the groups. Time to time, I have the flexibility to join with a group anytime, but only with a one group at a time. Likewise, so we'll try to do that from next week and onwards. Then even these questions you can discuss as a group and come up with the answer. From next week and onwards, we'll try to do that as well. So we participate in those discussions. That's something that I wanted to let you know. So if you don't have any questions, shall we take a break here? About 15 minutes. Is it okay? Anything?
Sir, the connection issue was there for last 1 hour, sir.
Last 1 hour?
Yeah.
Okay, I'll try it. However, during the break, I'll disconnect and come back. Let's see what would happen.
Okay, sir. Okay.
Okay, thanks. Okay, if not, I'll start this one. So can you remember 2 weeks back when I give the introduction for derivatives transactions, I mentioned two types of two categories of derivative transaction. One type is having a forward commitment. Once you enter into a derivative transactions, you get a forward commitment. The forward transactions and futures transactions are fall into that category. That means once anybody who enters into that sort of derivative contracts, you get a forward commitment. What is the other category that we discussed? So just highlighted. That's having some sort of contingent event or contingent claim or a, obligation. So option falls into that category. The buyer of the option does not get any obligation, but depending on certain circumstances or market situation or meeting some requirement, buyer of the contract can make a claim. So therefore, the option falls into the second category. So these are the things included in this presentation, small introduction, and what are the terms that we are going to use in option markets, types of options, and payoff diagrams for different type of options. So basically, now you may have to change your mind slightly, like forward, in a forward when or a future, when you enter into a transaction to buy something or to sell something, buyer buys the underlying, seller sells the underlying. That's the contract in a forward market or a futures market. That's the general perception we have. So whenever we say I buy something, I'm going to buy some underlying asset. But when it comes to the option, buying the option, it doesn't mean that you are going to, not necessarily that you are going to buy an asset. Remember that. Buying an option, it doesn't mean that you are going to buy the asset. But what do you buy? When you buy an option, you buy a right. You buy a right. What is your right? That may be to buy something or maybe to sell something for the specific underlying. We can say the right can be to buy an underlying asset or to sell an underlying asset. So generally, if you don't specify what is the type of the option, generally option gives a right to the option buyer. Is it clear? Option buyer gets a right we'll discuss what are the possible rights that the option buyer can get. We'll discuss soon. However, you have to be clear on that. In a futures contract, when you buy a futures, that means you entered into an agreement to buy the underlying asset. When you sell a future, you enter into an agreement to sell the underlying asset, and both parties have the obligation. On the expiry date, buyer has to pay cash, seller has to deliver the asset. That's forwards and futures. But in an option, it's not the case. Not both parties have the obligation. Only the seller has the obligation, but the buyer has the right. Is it clear? And make it clear now. Buyer get the right to do something. Remember, in that way, what to do, that's depending on that depends on the type of the option. We will discuss that. So, and the buyer does not get any obligation. That's also important. Buyer, there's no obligation. Once you buy the option, you have only the right to do what? It can be to sell the underlying asset, or it can be to buy the underlying asset, and the price is agreed and on or before a specified date. That is the nature or the basic structure of an option. Buyer gets a right to sell or buy a particular asset at a particular price on or before a specified date. But remember, when I say here to sell or buy a particular asset, it doesn't mean through a particular option transaction you get the right to buy and you get the right to sell. Only one of these, either to buy or either to sell. Only one. In a particular contract, you can get a right to sell or right to buy, not both. We'll clarify that in the next one. Is it clear? So you don't buy anything or you don't sell anything, but you have a right to buy the underlying or to sell the underlying depending on the type of the option that you entered into. And the thing is, there can be a maturity period or the time frame for the option transaction which is valid. You can do that either during the period or at the end of the period. But the price is pre-agreed. That's the basic concept of an option. And again, I reiterate, buyer get the right, but no obligation. But the seller of the option, the party who agrees to sell the option, again, remember, sell the option, not the underlying. The party who agrees to sell the option, we call them the seller. That seller assumes an obligation. Seller has an obligation. Whenever buyer comes and say, I want to do this, seller has to honor that. Seller cannot say, no, I can't do. Only if a certain conditions are met. Those conditions are specified in the contract. What are those conditions? We will get to know soon. So that's the basic nature. Buyer has a right, seller has the obligation. That's it. Buyer has no obligation to do whatsoever. So again, in option market, underlines, it can be any financial or asset or agricultural asset or any commodity, whatever. That what we discussed earlier, but not the last one. It can be an option on futures. So futures is itself a derivative. Options can be written or trade on another derivative as well. Not only options, there can be some other derivatives where the underlying transaction is another derivative. That it is possible in options. It's a very common thing. There can be options on futures. What does it mean? If someone buy a option contract, we call option contract, that may give a right that buyer to buy a futures contract or to sell a futures contract. So basically we use the word underlying to refer to the whatever the underlying asset, or it can be any of these. Underlying asset can be a bond or a foreign exchange currency pair, that basically then the base currency, or can be any commodity. It can refer to an interest rate. It can refer to a swap. Again, swap is also a derivative, or it can refer to a particular stock or a stock index or a particular futures, or can be basically anything, any asset. So we call it as the underlying asset. And then the other word that we are going to use, strike price or the exercise price. That refers to the price that you agree, the price of the underlying asset that the buyer is going to buy the asset or the seller is going to sell the asset. Which price that you are going to trade the underlying asset, that is the specified price. Remember again, here we are talking about the price of the underlying asset. It is not the price of the option. But in this instance, we have that. We have a price of the underlying asset as well as price of the option. Is it clear? Any questions? Any questions, please?
So on the last part, you said this one has price of the underlying asset as well as price of
Yes, strike price
So
or the
that means-
exercise price, both are the same.
Okay.
That we refer to the price on the underlying asset at which we are going to trade the underlying asset. If
But
you want to buy
the
the
option
underlying
price is
asset,
separate concept, right?
sorry,
The option price is separate concept here, right?
option price is separate from that. Yes.
Okay.
To buy the option, you have to pay a price that is separate from the price
This
that we are going to
is
discuss.
for the underlying, right?
This is for the underlying. Yes.
Okay.
That's the agreed price to buy the underlying, or this is the agreed price to sell the underlying. But to get that right, what you pay, it is different. So then buyer or the holder or the owner, that means buyer of the option or the holder of the option or the owner of the option, we call them as having a long position on the option. Long position on the option. Again, remember, it's not on the underlying. This is on the option. Long position on the option. And the other side, we call them as the seller or the writer. That party sell the option or write an option.
So
Generally, we call it right-hand
that is
option.
same party, right? So the same person, right? Seller or the writer, or do you
Yes,
have
yes.
different writer or different
So,
seller?
yeah, buyer, holder, owner, both are, we refer to the same party. Seller or the writer, again, the same party who sells the option.
The person who writes the option is the seller, right? I mean,
Yes, yes. You
it's
can
not
you
like
can
you.
call him as a seller or a writer.
Okay.
Whether you call it a seller or a writer, that party sells the option
Option.
and having a short position on the option. Is it clear? The seller or the writer, whatever we call it, or not whatever. So these two words we refer to the seller of the option who goes
So
short.
writing an option and selling an option would mean the same thing, right?
Same thing, same thing. That means selling an option, taking the obligation. But the buyer or the holder or the owner, all three words we may use interchangeably, refer to the party who buy the option and having a long position in option. Seller or the writer doing the same thing, selling options and having a short position and assume an obligation. Seller has the obligation. Buyer has no obligation, only the right. Then this premium. This is the cost to the buyer. That means that is the price the buyer of the option is paying to the seller. Premium is the price of the option. The buyer of the option is paying to the seller. Clear? And it's non-refundable. Premium is paid by the buyer to the seller of the option and it's non-refundable. It is the price of the option. We don't say like it's as price of the option. That's the premium
So
that
that
we
is the price you pay to acquire the right.
acquire the right. Exactly. When you buy the option, you get a right. To get that right, what is the price that you pay? It's like buying an insurance. Okay, if you buy an insurance, what do? You have to pay a premium. Then do you have any other obligation?
No, right? Yeah, I think we lost you there, sir.
Hello.
Yeah, we lost you there for a moment. The connection was interrupted.
Uh, is it okay
it's
now?
okay now. Okay, it seems now we have the same interruption again. Guys, you all have the same issue,
Yes, we
right?
have the same.
Yes, yes.
Okay.
Yes,
Yes,
yes. Yeah, same issue. We can't hear.
Hello.
It seems it's still interrupted. Yeah,
Still stuck.
yeah.
Yeah.
Hello.
Yeah, now we can hear you.
You can hear me.
Yes.
So can you see the screen or I have to share it again. So what I explained, buying an option, it's like buying an insurance.
Okay.
If you buy an insurance, to buy the insurance, you have to pay the premium. Is it? You pay a premium to buy the insurance.
Yeah, yeah.
Then as a buyer of the insurance, you don't have any other obligation. Once you pay the insurance and sign the contract, that's it. But to make a claim, there may be some certain conditions that you have to meet. Whether it's good conditions or bad conditions, it's a different thing. Once you meet that conditions, you can go to the insurance company and say, okay, pay me. Then if you have met all these conditions in the contract, the insurance company cannot say, no, I don't want to pay. That cannot be done. The insurance company has the obligation to honor your claim. Almost the same thing is true with the option. Option buyer has the right to go to the insurance option seller and make the claim once the conditions are met. Then the seller has to honor that claim. That's how it works. So the premium is the amount that you pay to buy that right. And like an insurance, so say assume you buy some insurance for a 1 year period. At the end of the period, you don't make any claim. You cannot ask that premium back. I didn't claim, so therefore please pay, give my premium back. It won't happen. It's not allowed. Same thing here. You pay the premium, you get the right. Whether you execute your right or not, you cannot ask the option seller to refund your premium. It's one-time payment. Once paid, it is done. Is it clear? Any questions? Then now we'll come to the exact specification of options. We can divide or group options into two depending on the right the buyer gets. What is the right that buyer gets? Depend on that, we can group options into two categories. The first one we call the call option. The call option. The other one is the put option. Those are the two categories. That depends on the what is the right the buyer gets. Because I mentioned earlier, in an option buyer get a right. I didn't mention what is that right. Now I'm going to specify what is the right. Depending on that right, how do we classify whether the option is a call option or a put option. And remember, and it is easy always options. Think about options from the buyer's point of view. Then exactly opposite is true for the seller of the option. Okay. What is an call option? The buyer of the call option, remember again, the buyer of the call option get a right to buy an asset or buy the underlying. The buyer of the call option get the right to buy the underlying. And the price is specified, agreed, that is the strike price or the exercise price we call, and on or before a specified date. The maturity date is defined. During that period or at the end of that period, buyer has a right to buy the asset at the agreed price, or we call it at the strike price, or we call it exercise price. Is it clear? If you buy an option, call option, what do you get? You get a right to buy the underlying. In the contract, you have to specify what is the underlying and what is the period of the contract, valid period, and what is the agreed price.
So these are also exchange traded, right? So they would be standardized terms, or is it like OTC as well?
Do
I
we have
can,
OTC options as well, or all of
yes.
these are?
Initially, most of the options are OTC. Now again, the trend is moving into exchanges.
Okay.
There are options trading in exchanges, but historically, most common things are OTC options.
Okay.
But however, here we are not going to distinguish the difference between OTC traded options and the exchange traded options. The only thing is, whenever it comes to exchange, the specified date and the specified price, those things you cannot customize.
So
That will be defined by the exchange.
Okay.
But in the OTC market, you can tailor-made to suit your requirement. That's the difference. Then there will be exchange rules that you have to follow, keep margin. Those things will be there when it trades in an exchange, but the basic won't change.
So when that is not traded on exchange, you don't have to keep those margins variation or maintenance or anything. Can you just
No, yes, most of the cases no, but
okay.
unless if the two parties
But still
agree,
it goes
then you
through
can.
broker, right? Oh,
Not necessary. No.
okay.
If it is OTC market, broker will come and bring both parties together. That's it.
Okay.
It's like any other OTC market transaction. But in the exchange, the broker's role is slightly different. He has to serve until the expiry of the contract. Clear?
Yes.
So my advice here is, don't think too much about whether the option is exchange traded or OTC traded. Try to distinguish between call option and the put options. We will discuss
Yeah.
soon.
Yeah. Sure.
Call option and the put option. Then the buyer of the option and the seller of the option. And more to come. We are going to categorize the type of options based on the whether you can execute your right only on the a specified day or within the period. So even though I mentioned here it's on or before a specified date, again we can restrict that and classify the options into two different categories. However, for the time being, concentrate on call option. In a call option, what do you get? As the buyer, you will get a right to buy the underlying asset at a price that you agreed during a period of time. Clear? And remember, you have only the right to buy. It doesn't mean you have to buy it. If you think, you can just let it go, expire the contract with doing anything. But to get the right, you have to pay the premium whenever you enter into that transaction. So in a call option, the option buyer gets the right to buy an underlying asset for a specified price on or before a specified date. So this is an example, contract 1. You bought a December 2020 call option on shares of ABC company. So again, I have used an example on a traded, exchange traded one. So that's why I have not specifically mentioned on which date in December. It is defined by the exchange. Don't worry about it. Somewhere in December, this option contract expires. You have bought a call option. That means you have the right to buy the underlying. What is the underlying asset here? What is the underlying asset here in this example?
Shares, right?
Shares of
Yeah.
ABC company. That's the underlying asset. Then the next bullet point says price of a December 2020 call option is 35.75. What does it mean? What is this? That is the price of the option. That means this is the premium. That's the price that you have to pay to buy this option. But thing is, this is the right you get to buy option, maybe not necessarily one share. This contract contains about 100 shares. However, to get that right, you have to pay 35.75 just to buy the right. Then what does it mean? Strike price of the call option, $66. If you want to buy the shares, you have to pay $66 per share. Clear? This price you pay at the beginning just to buy your right. This is the price you have to pay per unit of the underlying price when you buy the underlying asset. So this is the strike price. This is the premium.
So that option price would like differ on how much options you buy, right? I mean, it will be the total price will be the
Say in the OTC market, option price would give you per unit of the underlying asset.
okay. So
Say
for each unit you have to pay 35 to acquire the right, and then for each you have to pay 66 to purchase.
Purchase it, yes. But here, this is a option contract that on an exchange. So therefore, this is to buy the full contract. That means that contract consists more than one shares.
Okay.
Probably 100 shares. So therefore, per share you pay only 0.3575 to get the right.
Okay.
Clear, no?
Yes, thank you.
Yes. Generally, in the OTC market, the option price is given per unit of the underlying transaction. But when it comes to the exchange traded, since you have a bundle, that means number of units in the underlying asset in a contract, the option price is given for the whole lot. But the strike price is given per unit of the underlying asset.
Okay.
So then the put option, other one. So call option and the put option. In the put option, the buyer of the put option, again remember the buyer of the put option get the right to sell the asset. Other two conditions are remain same. You have to have a specified price and a expiry date of the contract. In a put option, what do you get? As a buyer, you get a right to sell the asset. If you are a buyer of a call option, you will get a right to buy the underlying asset. If you are a buyer of a sell
Hello.
Yeah, we lost you there, sir.
put option,
Hello.
So it seems the connection is getting interrupted now again.
you get the
Can't hear you.
Hello.
Can you hear me now?
Yes, sir. Now we.
Now can.
Now it's, I don't know, for some reason now line is dropping today. Maybe yeah, the load because kids are also on online classes today. Okay, in a put option, as a buyer, you get the right to sell the underlying asset. In a call option, the buyer get a right to buy the asset. And put option, you get the right to sell the asset. And the specified price and the specified time period are almost same as the call option. That condition are there. Only difference is whether you buy the asset or whether you sell the asset. The price and the time period has to be defined in the contract. So in a call option, you get the right to buy the asset. In a put option, you get the right to sell the asset. That's the key. Is it clear? Is it clear? What is an call option and what is a put option?
So in the put option, seller has the obligation to buy.
Yes. So
Okay.
whether it's a put or a call, seller has the obligation. Obligation to do what? The opposite of the buyer.
Okay.
So therefore, as I mentioned, always think about from the point of view. Buyer has the right. Option buyer has the right. If the option is a call option, the buyer has the right to buy the underlying. If the option is a put option, the buyer has the right to sell the underlying. That's it. Then the opposite is true for the seller of the option. If the option seller has sold a called option, he has the obligation to sell the asset. If the option seller has sold a put option, he has the obligation to buy the asset, because that's what exactly opposite the option buyer is going to do. Clear? I reiterate, always think in terms of option buyers point of. Think from the
Hello.
buyer's
So again, I think.
Yeah, the connection is,
point of view.
we can't hear you at all. Continuously breaking, the line is.
Try. Hello.
Now we can hear you, sir.
Now can hear.
Hello. Now you can hear. You can't do like this.
So is there
Okay,
any option to like turn off your video, like
I can turn
yeah,
off my
probably
video.
it'll help.
Yes.
Yeah, that should
Sometimes.
be
Yes.
useful.
But still you can see the screen.
Yes, yes, sir.
Yes. Yes. Okay. We'll try that. Yes, that's a good solution. So what I ask you to do, always think from the buyer's point of view. Whether it's a put option or a call option, always think from the buyer's point of view and come to the last conclusion from the buyer's point of view. If the question is from the seller's point of view, then flip it over. Always try to remember everything from the buyer's point of view. Whatever you get, the exact opposite is applicable for the seller. Only thing is premium is paid by the buyer to the seller. There's no payment from sellers to buyer at the beginning. That's only one way. With the profit or loss, if one party profit, other party loss. That's a very obvious reason, obvious thing. So always think from the buyer's point of view. If buyer sells, seller has to buy. Option seller has to buy. If the option buyer is going to sell the underlying asset, option seller has to buy the underlying asset. So therefore, it's easy. Remember or think always from the buyer's point of view. So is it clear? Call option and put option? Any question on that? If not, I'll move forward. Sorry, there's an example. Here, the almost same thing, December put option on XYZ company and price of a put option contract. This is the premium. This is the exercise or the strike price. So the buyer of this put option has the right to sell shares of XYZ company at a price of $378 per share. Remember that. That's the price per share. But the contract may be for 100 shares. So the premium that you have to pay to buy that right is $70. To buy the right to sell, you have to pay $70. That's the premium. Is it clear?
So excuse me, price for that price per share, no? Here you refer price of December 2022
No, this
2017.
is the price of the put option.
Is it for one share?
No, because this is a exchange traded product I'm referring here. It is for 100 shares. One contract consists of 100 shares. Like in futures, here one contract consists of 100 shares. So then this premium is for the whole contract. If you calculate the premium per share, it's only 0.7. But the strike price always gives per share or per unit of the underlying asset. Is it clear now?
Yes, sir, clear.
Okay.
Sir, where is it mentioned as 100?
I didn't hear that.
Where it mentioned as 100 shares?
No, that depends on the contract. Like what we discussed, futures contract, exchange will define what is the number of units included in a single contract. Can you remember in a oil contract, 1,000 barrel is one contract. In a dollar yen, 12.5 million yen. Likewise, from exchange to exchange, there are contracts, they specify the size. So if you are to give a that sort of contract, all those information will be given.
Here
So
you just mentioned that 100, I think.
Sorry, again, I didn't hear that.
Here you mentioned as 100 is just mentioned, or?
Yes, I just mentioned it for make it simple.
Okay, sir.
Because I have not referred to any exchange or any particular contract. I just assume it's 100 shares per contract. Anything else?
So in your examples, you assume that these are exchange traded
Yes.
options. Okay. But if it's a put option, you like in the exam,
It will give you all
the details.
whether it's a if it is a exchange traded contract, then all these information will be available. Yes.
So are these options available in Sri Lanka?
Yes. Over the counter markets, yes. Banks offer this. But it's not that liquid market, but time to time we can see this. Because we options you can trade over the counter. So in Sri Lanka, they do over the counter market. Any question? If not, shall I move to the next one? So this is about, so we are going to discuss about two more names, this American and European. So that's the classification based on the time when the buyer can exercise his right. Depending on that time period, we divide or we classify options into American style options or the European style options. So in the American style option, the buyer can exercise his or her right at any time during the period. That means on or before the expiry date. The American option gives the flexibility to the option buyer to exercise the right on or before the expiry date. So that means basically any day, any time until expiry, the buyer can exercise his or her right. Is it clear? Opposed to that,
Hello.
Excuse me, sir, we can't hear you.
So we lost you. It's getting interrupted.
European
Hello, sir.
We can't hear you, sir.
option hello.
Yeah, Mr. Shalom.
Yes.
Now we can hear.
Now you can hear me, but there may be a noise.
Yeah.
Yeah, I'll explain this and we'll stop here. So I explain you American option. In an American option, the option buyer has the right to exercise his right during any time until expiry date. In an American option, any day, any time until expiry. Remember that. On or before the expiry date. The option buyer has the right to exercise his right. But in an European option, that flexibility is not there. The buyer can exercise the right only on the expiry date. So that's the difference. So if this is the contract period, American option anywhere here. American option. But European options exactly on expiry date. That's the difference. Is it clear? And remember, whether it's a call option or a put option, it doesn't matter here. It can be a call option, American style. It can be a call option, European style. Or it can be a put option, American style or European style. What matters here, when the buyer can exercise his or her right, whether any time during the period or only on the expiry date. European style, that's the one we are more going to discuss in the future. Most of the examples would be European style one. So where the buyer can exercise his or her right only on the expiry date. Is it clear? Is it clear?
Yes, yes.
Yeah. Okay. Now tell me. So the price, say same maturity, same strike price, or all the conditions are same, but there are two options. One is American, one is European. Which one would have the high price?
It'll be American one, right? Because you have more flexibility there.
Yes, exactly. American one will get a higher price because the buyer has more flexibility. So always American options price are higher than the European options. So that's the basic. So I'll quickly summarize what we discussed on options. There are two types of options.
So can you see the slide, please?
Sorry?
We can't see the slide actually.
You can't see the slide?
Yeah.
Huh?
Can't see, sir.
Oh, yes. So what I review here, American option can be exercised anytime during the time period, but European style only on the expiry date. Since the American option has more flexibility, price of the European style is, price of the American style options are higher than the similar European option. What do I mean by similar? Same underline and the same expiry date and the same strike price, because the price may change depending on the strike and the maturity. All those things we'll discuss in future. What are the factors that affect the option pricing? American and European style with all the others remain same. American options are having high prices than the European options. So in summary, option gives the right to the buyer. Option gives the right to the buyer, but no obligation. Option seller has the obligation. Then we divide options into two categories depending on the right the buyer gets: call option and the put option. In the call option, the buyer gets the right to buy the underlying. In the put option, buyer gets the right to sell the underlying. Then again, we divide options into two groups, American style and European style, depending on when the buyer can exercise his or her right. If the buyer can exercise that right during the period anytime, then it's an American option. In an European option, the buyer can exercise the right only on the expiry date. That's the summary that we discussed so far on options. Any questions on that? Any questions? If you don't have any questions, we'll stop here and we'll discuss or continue to discuss options from next week. If you have any questions, please raise. Hope you can hear me.
Yes, sir. Yes, we can.
Okay. So is there any question? If not, we'll stop here. But next week, remember or get ready to participate in small discussions. So whatever the number of participants join in the group, the system itself will randomly put you into different groups, and then you can discuss and come up with the answer. Depending on the situation, we'll try to do that 2 or 3 exercises like that. Then you can share your knowledge among yourself as well. So anything else? Okay, if you don't have any questions, we'll stop here. Sorry for the interruptions.
Thank you, sir.
Thank you, sir. Thank you.
Thanks.